This episode of the Altco's Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts going mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're going
creators
mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Altco's Mainstream podcast. On today's episode, we have a guest who has consistently and astutely figured out the growth area and found a way to play a part in its development. We are joined by Manulife's new Global Head of Private Markets, Valentine Andrews. She's responsible for the strategy, business development, and growth of Manulife Investment Management's private markets business. Manulife has a platform that spans real estate, infrastructure, timber, agriculture, private equity, and credit. Anne has a comprehensive and informed purview of both private market trends and of different asset classes, which she brings to bear leading the private markets investment teams, bringing together the CIOs from each asset class in the Manulife business, and works with the global product group to drive private market product innovation across institutional, retail, and retirement channels. Anne has a wealth of experience in private markets and in infrastructure in particular. She joined Manulife from BlackRock, where she was most recently global head of infrastructure and real estate. Previously, she was co-head and chief operating officer for Morgan Stanley's infrastructure platform and was also a director at Macquarie Bank. Anne and I had a fascinating conversation about the evolution of private markets and how to build out private markets investments platform and its brand. We discuss how to approach building a private markets investment platform at an industry behemoth, why culture matters at an investment firm, continued consolidation of alternative asset managers, what it means to connect real assets with real money, how to build a brand and educate investors, the opportunity in infrastructure investing, and how to bring private markets investment opportunities into retirement accounts. Thanks, Anne, for coming on the show to share your experience and wisdom on private markets. We hope you enjoy.
We're going mainstream.
Anne, welcome to the Altco's Mainstream podcast.
Thank you for having me. I'm very excited to be here.
Pleasure to have you. We'll have such a fascinating conversation about all the work you've done in private markets. You've had an incredible career. Now you're building a business at Manulife. I want to start with, how did you end up in private markets?
I grew up in Australia. I trained as a lawyer, and I didn't like being a lawyer. So I looked around to see where there was growth, and it was at Macquarie Bank. Back in the day, Macquarie was very big in investing in infrastructure. Why? Because the government was privatizing assets. They were also simultaneously having people save for retirement. So Macquarie stepped in and matched those two things up. So I literally jumped from not liking being a lawyer into infrastructure 25 years ago. But it was really just following growth, right? As a young person straight out of university. That's the advice I always give to people. Look where things are moving and where capital's flowing and jump into that.
At that point in time, was infrastructure as big as it is today? Because it feels like there's a number of tectonic shifts in today's world, and private markets in particular, that's making infrastructure such a big deal.
It's interesting because back then, there are only a few people really doing infrastructure. It was a few Australians and a few English managers. All of the big names that you know today were not looking at infrastructure. It was a much, much smaller market, again, driven by forces in Australia and the UK. Apart from if you're in Australia or the UK, you didn't have it as an allocation. Allocators weren't sitting there thinking, I need to allocate to infrastructure. So managers were not really paying as much attention to it as they needed to. I can remember even when I moved to the US, I moved here 23 years ago, and I would go around and meet with people and say, I worked at Macquarie and we're investing in infrastructure, and people would think that was the strangest thing ever. And that was only 23 years ago. So I think that you talk about tectonic shifts, there has been a huge shift just in the last 20 years. Back then, the asset class was toll roads, power stations, airports. The big privatizations of airports is what drove a lot of the growth. That was infrastructure. Fast forward to today, and you talk about tectonic shifts, the move to the energy transition and to make everything greener has really exploded infrastructure. Many more interesting things to invest into. Also, probably the move to net zero around the world. The supply side has exploded. So a lot of big moves. You meet people that have infrastructure or real assets on their business card who are looking to give capital to people who are infrastructure managers. That's all happened in the last 20 years.
I want to start there and unpack a little bit about infrastructure and also marry that with the progression and evolution of your own career. But if we think about what infrastructure was as an investment strategy back when you started advising and also investing in infrastructure deals, where and how did people think about putting this into their portfolio? Where did it sit?
It sat in a couple of places. It sat either as a carve-off of real estate, and some people said it sort of looks a little bit like real estate. Some folks even look for it in private equity, and also fixed income. People were looking at the characteristics of infrastructure, the yields, the long-term nature of it, the low correlation, the alignment with inflation. People were looking for places to put it in. But eventually, it became its own category. We worked with many people to fill in white papers to get approval to make it its own asset class. Remember, back in the day, it was nascent as an equity investment. People were concerned how it was really going to operate through a recession or through a down market. Then we had the GFC, and then we obviously had COVID. And so people have been able to see that infrastructure really does have those resiliency characteristics because it's essential to life. So that really is something that's now also given it a huge push because people have seen these long-term contracts that really do work. Having those tests in those very, very bad markets accelerated it. If I went back in time, a lot of the infrastructure funds looked the same. They didn't look very different. Now you've got debt funds, you've got core funds, which are evergreen. You've got core plus funds. You've got higher returning funds that are closed in that look more like PE funds. It's really developed into this very differentiated asset class, which looks much more like real estate, for example. So it's matured and it's grown up, and people are able to access it in all different ways, depending on what they're looking to get out of it.
You talk about space maturing and growing up. When you were starting in infrastructure, it was tens, maybe hundreds of billions of AUM collectively. Now it's trillions. How did you think about, to your point earlier of finding the growth area, how did you think about your career and every point at which you were at Macquarie, one of the best infrastructure investors in the world, then Morgan Stanley, then BlackRock, all massive infrastructure platforms, now Manulife. How did you think about that career evolution and trying to find that next growth area, even within infrastructure?
It's fascinating how careers unfold, and they look incredibly intentional when you're looking backwards. But at the time, obviously, you're reacting to moments and you're reacting to where there's growth and where there's not growth. When I was at Macquarie, I was there for a very long period of time, both in Australia and New York, and loved that. The interesting thing was I was very focused on what I saw as the burgeoning infrastructure market in the US and how large that market was going to become. So when I made the move from Macquarie to Morgan Stanley, I saw an opportunity to really grow at a huge international firm that had a head office in the US that really wanted to put a lot of resources into a global fund, which is why I made the move to Morgan Stanley. The BlackRock move was also a similar growth move. BlackRock at the time was nascent in infrastructure. They only had a very small renewables fund. And at that time, renewables was strange. When I joined BlackRock, having just a renewables fund was very odd. We met with investors. People actually said to me back then in 2012, 2013, we think renewables is going to go away. We don't see this as an asset class that's going to grow. It's got subsidies. It's not going to really be a thing. So that was 2013, 10 years ago. I joined and the vision was to build out a very diverse platform. And so I think the career is, again, growing and looking to where you can add a lot of value and you can get on fast-moving trains. BlackRock was looking to grow and diversify, and that's also the same story with Manulife, but really up a level, not just infrastructure anymore or real estate, but the whole alts platform. And a bit like your podcast, Michael, this is alts going mainstream, having a larger platform with all of the different asset classes. Now that market participants are looking for much more from each of their players. I think back in time, the boutique was something that was more interesting. Now it's how can I get much more from my providers and how can I push them to solve my problems? My move to Manulife was reacting to that market trend. You need to have, I believe, a bigger platform that you can offer much more from. So that was really what brought me to Manulife.
Let's talk about that because I think that is such an interesting evolution in private markets. And it gets to so many aspects of the evolution of these businesses, as well as how to work with new entrants on the LP side, like the wealth channel, where brand may matter, to your point. How do you think about building a platform that provides a comprehensive set of services and strategies to investors?
It's a great question because that's what I'm focused on right now. I joined Manulife earlier this year. I think a lot about how do you provide excellence and how do you provide something that people really need. So you start with what you have. In any version of building a platform, you have to understand deeply what's already there. That is, first up, investment performance. Any amount of marketing or any amount of talking about something, if you don't have the ability to find excellent deals and put them in a wrapper, that is what people want, and continue to do that over time, it doesn't matter what you have. So first, looking at the teams, looking at the excellence of what they have, and then looking at how we can add to that. First up, you've got to know what you've got. At Manulife, we actually have been building for over 100 years. First with the money from the balance sheet, and then with third-party money. We have infrastructure, we have real estate, we have private equity and credit, and then we have timber and ag. We're actually the leading natural capital manager in the world through the acquisition of John Hancock 20-odd years ago. So you look at what you have and you understand where there's excellence within. To your point, many investors know our platform based on certain parts of how they've interacted with it. I have the great job of making sure everyone understands what we have and the vision that we have to continue to build that. To your point, you can build in many different ways. I sort of think about it as degrees of difficulty when you're looking at anything. You've got an excellent team and they're already doing something, maybe one product. You can get them to do another product quite easily because they've already got a reputation, they've already got a set of limited partners, and they've already got excellence in terms of their flywheel running. Getting a brand new team on board is harder, but it's possible. And then the very hardest thing of all is buying a third-party manager and then trying to bring that in and make that work. So I look at all of those different options, and I also think about the hardness difficulty as well, because you want to do a mix of all those things, organic and inorganic, but you've got to meld it all together with culture, because it's all about people at the end of the day. The machines haven't taken over yet. So it's all about people and culture and making sure that you've got that optimized as well. It's doing a broad range of things, but performance is number one, number two, and number three. You've got to have that. You've got to be generating alpha for people, or you may as well stop.
On that point, you've come into Manulife at a really interesting time in the context of private markets more broadly. There's been a number of firms who've acquired large firms and platforms to add to their capabilities, particularly on the traditional asset manager side. There's been a number of landmark acquisitions recently, whether it's secondaries funds, infrastructure funds, you name it. How do you think about looking at what others have done and say, okay, we have a really interesting deck of cards that we can play. How do we want to do that?
And doing acquisitions, as many people know, a lot of acquisitions done are not successful. It's easy to do a deal. It's incredibly easy to do a deal, but to make it successful over the next 3-5 years is incredibly hard. Why? I think people don't spend enough time thinking about how it's going to work when it all comes together. I think people focus very much on, I need this capability, or I need this ability to offer credit or PE or real estate, but they don't think about how it's actually going to work when it comes into the organization. I think it's incredibly important to spend time thinking up front on when these individuals arrive, how is it going to work? And how is it going to work in our organization? They're focused on governance. They're focused on ease of getting things done. They're focused on compensation. They're focused on fundraising. And how is it actually going to work? It's imperative to have those really hard conversations up front and make sure there's 100% alignment. My experience from doing acquisitions is you actually want to have a firm view, but you want to rip the Band-Aid off up front in terms of not delaying things and making sure everything's 100% clear. It's hard. It's really hard to make these things work. And particularly when you've got some cultures who are just different to start with, making sure you're really spending time up front and that there's a complete meeting of the minds. So there's not, people departing weeks or months or years afterwards, because it's a people business, right? Investors want to see a plan. They want to see happiness. They want to see calmness. They want to see excitedness from the people who've joined. And if you don't have any one of those things, the capital is not going to flow. It's all about the people, and spending more time up front and be real with yourself about different cultures. I think that's where a lot of these things fall over. They're going to continue to fall over, by the way. That's what I spend a lot of time thinking about in terms of the right cultural matches, but also the right structures to operate things.
How do you evaluate culture and culture fit?
I think you've got to start with what you are as a culture and what you are as an organization and be honest about that. And then I think you've got to look at the different targets that you're meeting with and also understand their genesis. If you're a very large organization that has no alternative management expertise and you're looking to plug in a boutique manager who's never filled in a form for a mobile phone or thinks they can fire an assistant without talking to anyone, they're the two examples I always give. Those clashes of cultures are going to be extraordinary. And I'm giving the two pure, a liquid manager taking on an alts manager that's a boutique that's never been institutionalized. The closer you can get those two things and the more expertise you have at the acquiring parent or the investing parent from the alternatives world, I think that starts to blend. People have to be clear about culture. How do things get done? How do decisions get made? How many people need to look at things? What can I do? Can I sign off on a deal? Are you going to join my investment committee? What if I want to hire? All those sorts of key decision makers. It's a bit like doing a deal at an asset level. What rights do you have? What rights don't you have? And I think that you've got to put a really clear term sheet together and hash these things out up front. Culture is how we do things and what we expect from people, but it's also the day-to-day, how decisions are going to get made and how things are going to get done. So I think it's being open and honest about yourself and having someone that can speak the language between both cultures.
How do you think about transmitting culture that you want to have as the manager of assets or platforms to LPs?
I think it's very important as a GP and as a large platform to communicate what you stand for and what you're focused on and where you're growing. Actually, one of the things that we did when I joined Manulife is look at what it is that we stand for. It's like we stand for partnership. We want to build, we want to partner because we've had this GA heritage. We've had a long sustainability history. I mentioned the natural capital. I mean, it's just intrinsic to everything that we do on every asset class. We stand for stewardship. We're an insurance company that's managing capital for a very long period of time. So we refresh what it is that we stand for, and that really imbues everything we talk about as we look to partner with people at the asset level. So communication, it's a competitive world. Everyone's offering something very different. So I think it's a matter of being clear and just communicating what it is that Manulife stands for, right? And being simple is not always easy, as you know. So that was one of the first things that I wanted us to do when I joined, is be able to communicate that in a simple way and have everyone saying the same things.
You're talking about something that I think is so important, but so hard to get right, particularly as an entirely new cohort of investors come into private markets, the wealth channel. How do you think about building brand in this new world of private markets? And you also had the benefit of being at a pioneer of really a category at BlackRock for a number of years. You probably saw that firsthand in terms of building brand category on the more traditional asset management side. How do you think about building brand in private markets? And what do you think you'll do going forward as there's this whole new cohort of investors coming into the market?
Yeah, it's super exciting having private wealth come in. I've been investing in alternatives personally for many years because I've had access to it myself. It's incredibly different. The first time you get a capital call statement, having to wire capital to a fund, having K1s, it's not simple, but the returns can be fantastic. You get access to a very broad range of asset classes. The fundamental belief that more and more people should have access to private markets, I think, is fundamental to what we're building. We're fortunate that through our network, we have access to thousands and thousands of FAs all around the world through the insurance network. Manulife has been in Asia for years. We've obviously been in Canada for years, and through John Hancock, we've been here in the US for years. But the FAs are not as used to, as on the institutional side, as selling private markets. So a big part of this is education. You and I understand all of this because we've cut the wires, we've cut the checks, we've lived through it, we've invested. But until you understand how these funds work, there's just a huge educational component. So that's what we're doing at the moment. A little bit the same as on the institutional side, where we have sales folks and then we have specialist sales folks, like alternative specialist sales folks. We're investing heavily in that at the moment, the people who can go out and explain how this all works. And we're also investing heavily in different structures, how to get that wrapper in place that allows an individual to get more liquidity. As everyone thinks they need more liquidity than they do, having those different structures, the interval funds, the BDC, all these other structures that allow us to go in. So we're investing incredibly in that educational part of it. Another aspect of this, we have a huge retirement platform at Manulife where we manage 401k accounts. As recently as a few weeks ago, we're having discussions about the holy grail of getting alternatives into 401ks, which again, as we know, as long-term investors accessing these markets, which are more and more interesting with less companies listed, and you're building and building and building, you should have alternatives in here. But some of the structural issues with people changing jobs and pulling down on their money, it's not as developed as it is in somewhere like Australia, where it's much more developed and people manage their own super. So this is something that we're also very focused on. I call it the holy grail because we're going to get there one day. And again, we are lucky in that we have it off to the side ourselves. But again, everybody should be able to have access to these and the transactions that we invest in.
You mentioned it, so I'm going to have to go there. What's it going to take to get alternatives into 401ks? Because from a duration perspective, there is matching. It's a long-term investment vehicle that people are incentivized to hold. There's benefits to doing so. That matches very well with the illiquid nature of many private markets investments. So what's it going to take to get there?
It's a lot. It's going to be a lot. But everybody's spending time on this. Everybody's trying to work out the answer. With the increased focus on retirement and the increased focus here on, we're really underdone on this topic. People are not saving. So I think there's going to be more and more focus on this as time goes on, and individuals are going to focus on it as well. But I'm happy to give you updates as we continue to push on this. But it's going to happen ultimately. And I think it will happen once people understand that we don't need to have full liquidity the whole time. Like, you can leave a portion. The same way it happens in institutional portfolios. There's a portion you can leave that just is okay, and just leave that. But I think we need to move to the people managing their own retirement funds, so it's not as linked to employers. And again, we're not there yet. That's where Australia's moved to. A lot of Australia's moving that way, but it's tough. And people are drawing down on their 401ks more than they should be as well, right?
That also gets into a really interesting point of people are managing their 401ks more. How should alternatives be? I think we probably both agree they're still sold, not bought, but do they become more bought than sold? And maybe that's also related to structure, as you mentioned, the way in which products are structured, whether it be evergreen funds, interval funds, which are a bit different in terms of how people invest. There's a single capital call rather than multiple capital calls in a drawdown fund. How do you think all of those things kind of go together as alts takes its next step into the mainstream?
So I think a couple of things, and this goes back to what we talked about at the start. The access point has to be across an alts portfolio. I think about my own personal portfolio. I'm able to invest in a whole lot of different asset classes in a diversified way, the same way you would on equities, the same way you would on bonds. So making it easier and making it more diversified across a whole range of asset classes, I think is the answer. Because at the moment, you get real estate, you get private equity. It's hard. It's hard to do that, and it's complicated, and you're asking people to pick a lot of things. So I think having the broadness of diversification and having that added in as an easy option so that it's kind of like the default option. The same way I go in now, I can pick a default option. I pick the year that I'm retiring and it's all there for me. I think that's where we need to get to. It needs to be just part of a preset default, the same way that people should automatically be enrolled. We need to make it more organized for people, and it needs to be diversified. It has to be diversified because people will choose and they will choose bad options.
So does a less diversified world of choice mean one-stop shops? People go to a specific brand, they can get the host of strategies that that brand offers, whether it's a combination of private equity, private credit, infrastructure, real estate, maybe secondaries, GP stakes, whatever it may be, all wrapped in one platform, and they just pick the brand, choose that brand, and get a diverse set of strategies?
Yeah, that's what I think is the answer, Michael. Again, I always go back to Jeff Bezos, and when he talks about it, you got to have frictionless ways of operating and just make it easy for people. And that's what I'd invest in. Give me the best of across a platform. It's making it easy, making it diversified, and providing good returns for people. Having the platform, we were in a world of boutiques and people looking to pick this one, that one, this one. I think the ease of investing and the ease of access is going to start to trump that. And it is already doing that with just the platformization of alternatives. Alternatives go mainstream.
So you bring up a really interesting point. And if we take your hypothesis that there's going to be this platformization of alts and people will go to one-stop shops to get everything because it's easy, how does one think about building a brand? Because then brand becomes what's important. And the way in which you think about marketing that brand, the way in which you show the competencies of that brand probably become a little bit different than in the world of boutiques. What does that look like?
I think, it gets to people having a direct relationship with the customer and having a brand that they understand and that they relate to, which is, again, where someone like Manulife that has all those relationships on the insurance side and has developed those over many years and has a brand that's trustworthy and has a brand that people rely on. And I think it is important to have these things where people understand who you are and understand that they can rely on you and trust you and that you're going to do a good job for them. For the longest time, the focus has been just on the institutional world, and that's going to continue, by the way. That's obviously the largest source of capital, sovereign wealth funds, insurers, all that sort of stuff. But then building a brand for high net worth and more general folks, that's where we're up to right now. But you've got to start with having the expertise and having the platform first. You've got to have a platform to start with, because I do think starting from scratch, which maybe 10, 15 years ago you could do, I think starting from scratch is harder these days. I just think it's very difficult now. We saw through all of the change, COVID, people sort of flight to existing managers, flight to names. And I think that's going to be very hard to reverse, to be honest.
So when you mention building a brand and you mention the name Amazon, I can't help but think that there are probably ways to learn from different industries in terms of building brand. Are there any particular examples or firms that have built brands that you look to maybe outside of financial services that you say, wow, they did an amazing job of doing that. We can learn a lot from that and apply that here as we build brands in private markets?
So I do love thinking about brands as well. I do think of Amazon and how life has evolved onto our phones, onto everything that we do. We're doing this online. I think a lot can be learned from Amazon. The customer's always right. You want to take care. You want to do everything in one place. You want to communicate seamlessly. You want to be able to do things quickly. And it's done in a sort of a beautiful way. It's not complicated. And so in alternatives, I do think we need to make it much more simple. And I do think we need to make it easier for people to invest. And I think there is a big evolution that's happening. We talked about K1, so this all has to change for people to be able to do this in a regular way. And it's going to happen just because of the volume of capital it's moving, and also because of the fact that less companies listed. So it's going to happen. So being at the forefront of that and marrying more consumer practices together and breaking down those barriers, I think the companies that you like dealing with that are easy and that you do more and more with, I think if we were having this conversation in 10 years' time, that's the companies that are going to win. They're winning this race, trying to move from a purely institutional business to a more democratized business.
Well, it's also related to the fact that younger generations are wealthier than ever, right?
Yes.
And they also have a different way of interacting with brands, as well as how they purchase things, whether it's online or offline. I have to imagine that as you think about the next 10, 20 years of evolution of asset management in private markets, that's also going to have to change and factor into how you think about working with and engaging those end consumers.
I agree with you. It has really been a focus, and now the world has really opened up. So I do think that there does need to be a change, and that more consumerism does need to blend in. So no, I agree with you.
So we talk about change. Another aspect of change that I want to cover is something that Apollo CEO Mark Rowan referenced recently at the Norges Bank Investment Management Conference. He talked about the fact that there have been a host of things that were true in markets. I'll name a few. Low interest rates. You have a concentration of returns in certain public market stocks, indexation, this move to passive, all of these things. There's less companies, as you mentioned as well, in public markets than there were 10 years ago. So there's more companies in private markets, and yet many people can't access them. So we've entered this very different world today, now higher rates, increasing challenges geopolitically, conflict, et cetera. The last 20, 30 years may have been very different than the next 10, 20, 30 years. What does that mean for investing to you?
It's a big question. My experience over the last 30 years is that as people, we tend to take what's happened in the last few years and then project that forward for a very long period of time. So yes, I think we've finished the sort of the great moderation, this time when rates just kept going down and you could do anything. You could buy a home or a toll road or a forest, and you could refinance it and you could make money. So now what's going to happen going forward? I actually don't know what rates are going to do over the next 10 years. And I'm comfortable saying that now after having lived for the last 30 years. But what I do know is a couple of things. What's not going to change is looking for that excellence in terms of investments and being able to generate alpha. And you can't do it now just through refinancing and doing tricky things with lending. You need to be able to do it through actual operational improvements, through rolling out businesses, taking out costs, increasing EBITDA through generating new income streams. You need to actually be able to do stuff, real stuff. And so that's what I know. That's going to keep. And that was always the case. There were other things obscuring it when rates kept going down, but you need to do that. I think you also need to follow the big mega trends. There's things happening in the world today. I don't know if they're going to happen this year, 5 years, 10 years. But again, if we were talking in 10 years, the increasing focus on decarbonizing the world. 10 years ago, no one cared. People talking about that would think that they were working for Greenpeace. It was odd. Now it's normal. Everyone's accepting that it's happening. How do I invest in this? Everyone's very focused on the energy transition, but we need to decarbonize every part of this world. Manufacturing, agriculture, production, everything. So energy transition, big focus, but it's going to continue, and that's where the natural capital thing comes in. demographics. Where are the people going? We're aging in the developed world, and then there's a whole emerging market that's still having thousands of kids. So there's all these big trends. I think if you step back and think less about what's happening right now, but look, where are these big mega trends moving over the next decades? You talked about deglobalization, all the conflicts happening in the world. That's interesting. People are now nearshoring, building more manufacturing in the US and Mexico. That didn't happen 10 years ago. So again, we like to look at these big mega trends. We're very long-term investors, focused on how to generate and really make money. And then also, where are we putting it? Because we want to invest for 5, 10, 15 years and think holistically. I try to push us to think long-term, and it's tricky.
I totally appreciate and hear you about investing for the long term. Now, it also feels like we've entered a world where cycles happen faster, both innovation cycles, but also market cycles. And this is, I think, in part due to the speed at which people get information, the way in which people invest. And I think people are probably more impatient than they used to be as well, thanks to the advent and increases of technology, social media, et cetera. How do you kind of balance those two competing views that I just stated?
Well, again, that's kind of the beautiful thing about private markets. People trade a lot based on news, based on TikTok, based on whatever they're looking at. That's the beauty of private markets. You're making investment decisions that cannot be turned around, and you're investing into trends. You're forced, just by the nature of it, to be much more calm, to be much more thoughtful. We're not investing in something every day. Sometimes it takes 6 months, 9 months, a year to find the right management team to partner with. So it's a much more thoughtful asset class just by the nature of how you run it. And I think that's good. Being able to not make snap decisions, being able to consider things over a long period of time. I actually think that's one of the benefits of being less listed and less reactive. I actually think that helps folks. That's definitely been my experience in terms of watching how you've been able to grow businesses over a long period of time. Find an excellent management team. We invested into a community battery storage company that's helping the New York grid, 9 and this business gets built over many, many years, partnering with the government, partnering with Con Ed, working out where to put these batteries. It's beautiful to watch these businesses grow, but we're talking about 5, 10, 15-year businesses. Something doesn't happen every day. And then all of a sudden, you've created a fantastic platform. And one day you can exit that and move on to building the next thing, but it doesn't happen overnight. So I think there's much more measured and much more controlled. And I actually think that that's one of the benefits of private markets. So you don't sell, you just hold on. That's generally okay.
Boring can be beautiful. And on that point, I think many people get excited about private markets when they hear about all this innovation and they can get access to private technology companies. And then sure, that's exciting. There's no doubt about that. But there's probably also a portion of their portfolios that should be in, and I don't mean boring in a bad way, they're allocations that are long-term that takes a little bit of time for them to develop, but end up being really good investments for people to have, and maybe also have different qualities and characteristics. I think Manulife put out a 2022 paper that showed that US farmland had a similar annualized nominal return to private equity. I think it was around 12%, but half the standard deviation. So when you hear something like that, how do you think about what that means for an investor's portfolio, and how should they think about all of that in the context of exposures to private markets?
Well, thank you for mentioning that study. The diversification, I think, is kind of like the last free lunch that exists in the world. And you're talking to an infrastructure investor. So I'm very much a person who likes to have a diversified portfolio and understand that that can be a better portfolio because of the risk characteristics you just talked about. Investing in forests and in agriculture is important in the world because Mother Nature, we only have one. I was at Milken recently listening to Elon Musk spoke, and his big focus is on we need to be multi-planetary. It's basically something will happen to us eventually, meaning either we'll do something to ourselves or an asteroid will hit us, or something will happen. So we need to be on another planet. We feel dearly that we need to protect this planet as much as we can. So that's where the whole natural capital comes into it. That's why we've spent a lot of time building that business. And we're actually building the whole carbon element of that business now too, like carbon credits. There's a lot of demand in the world for that. Again, it's still nascent, but we're very big believers in natural capital and being able to optimize carbon credits.
You're bringing up something that's, I think, a really important point and ties to the discussion we had earlier about brand. But how do you connect real assets to real money? So what I mean by that is there's end investors, whether it's through 401k, through intermediary, but at the end of the day, it's real money that's investing these dollars. And you have real assets on the other side. These assets are being put to work to help the world that people live in. How do you educate investors that investing in infrastructure is actually an investment in helping themselves build the world that they live in?
It's like you're asking questions that are sort of titles on presentations. And the funny thing is, investors, and I'm talking now about institutional investors, but also about private investors, that one of the beautiful things about real assets, we're talking about infrastructure, real estate, ag, timber, is that people love going to visit these assets and love when they realize it's what makes the world go around. One of the most popular things that we do as a manager is take people to visit assets. It's always my favorite day when we go on a site visit. You can visit a distribution center on the real estate side. It's incredibly interesting. So I think the best thing we do is take people to visit these places. And I can tell you, investors love visiting. Easy on the institutional side because we have annual meetings and we take them and we show them. But I think you make a really good point in terms of as we continue to develop this, how do you make the simple connection with the whole world is real assets? I once did a presentation at an investor conference that started with photos of the Pantheon and things that have been going from the beginning of time. Whenever you go to a place, what do? You take photos of real assets. But it's not just the things we built, it's also the things that exist already, the trees and the agriculture, the soil and the air and the sun that powers all of our renewables, something that I'm incredibly passionate about. It is the world that we live in. So I think that question you just asked is literally, it's like the title of the essential guide to building the world and investing in the world. And that's what we all need to do more of. People enjoy investing in these things because people like investing in the world and like seeing what they invest in.
Well, the beautiful thing about that as well is now as more access gets unlocked to private markets, people can actually invest in things that they then use. And we know how important it is to create that connection. When people are investing in something, they're more likely to want to use it. And that concept, I think, at large scale, because I think something like infrastructure, we all walk through airports all the time. Those are, in many cases, financed by private equity firms. We just don't necessarily think about that or make that connection. And I think it's fascinating to think about that.
They are. And airports revenues, a lot of airport revenues are retail. It's like a big mall. Then planes land there. That's really how airports work. In Australia, they privatize lots of assets. Australia has many listed assets too. Like my mother in her superannuation account, the equivalent of a 401k, owns toll roads and thinks about that. And this is my mum. As she drives, pays the toll, I'm owning that. And again, it's a simple concept, but you're right on. It's making it easy. And at the end of the day, it's pretty simple. It's not complicated.
Tying that to something you mentioned earlier, which is decarbonization and natural capital, how do you think about linking those things together with what we just talked about? Because it's so important that we make this energy transition happen. It's necessary for the world we want to live in. How do you think about that at Manulife?
People weren't talking about this 10 years ago. And again, I mentioned that when we talked about renewables, a number of investors thought that they were going to go away. So again, that tells you how far we've come in 10 years. We're now talking about how to decarbonize. And people are both on the early stage venture side, looking at lots of technology, looking at other ways to do things, all the way through to infrastructure. We've got to get to net zero. Countries, companies, individuals have all made commitments to get there. And so the energy transition is actually the easiest part of it. Lots of renewables. We're now going to upgrade the grid. We've got battery storage, the energy and charging our cars. Everyone can see how to get there on that. It's the other part that's harder. I would give us a great grade on the energy transition. We've done that well, and that's been the last 10 years, like tick, tick. Now, 40% of the world is buildings. How do you decarbonize buildings? Harder. How do you decarbonize the manufacturing process? Cement, steel, all these big things that we build the world with. Agriculture, eating meat is terrible. Cows are terrible for the environment. The next 10 years, I think that is going to be the focus. It's going to move from just talking about energy transition to talking about how we transition, and it's harder. And so what's fascinating about that is, and you invest in early stage stuff, it's going to take everyone, lots more ideas, lots more capital. And I think also that's where the natural capital side comes in. I think there's going to be a greater appreciation for not just the built world, but the world that exists that we found when we first moved here. And so it's that next part of the decarbonization journey. That's when we get into carbon pricing. That's when we get into like, how do we really do this hard part? I think of decarbonization just as a big thematic that goes across everything, and that we need to start thinking about those other buckets more.
So how do you think about the risks associated with that? Because anytime there's significant amount of capital flows into the space, one, it shows that there's an opportunity, but two, on the flip side, it shows that there's also potential diminishing returns and risks associated with that. I think it was the G20's Global Infrastructure Outlook a few years ago. I think they estimated there's a $15 trillion infrastructure funding gap by 2040. And that means that there's obviously a lot of capital that can flow into the space, but infrastructure is a space that has grown massively, even just in your career span in this space. How do you think about the risks associated with this massive flow of capital coming into the space?
Look, I think it's like anything, and it's not just an infrastructure question, it's an everything question. There are going to be winners and losers. And just because it's labeled transition, it doesn't mean it's going to make money. I think it goes back to some of the things we touched on at the start. Who are you investing with? What's their experience? What's their strategy? Because at the end of the day, it goes down to, I'm giving money to individuals who are making investment decisions on my behalf. And so you have to have a lot of confidence in what those individuals are doing. And the robots haven't taken over yet. It's individual to individual. You have a great deal of due diligence. You have to believe in what individuals are doing. And I think you have to invest against strategies that you believe in and be comfortable with the amount of risk you're taking. Infrastructure, real estate, natural capital, all these asset classes, even we can talk about credit, have inherent risk, and you have to work out what risk you're comfortable with and what the manager's doing. Are they putting leverage on leverage? Are they investing in places that you're not comfortable with? There's a lot of things under the hood that you have to look at to understand what you're comfortable with doing. So I don't think anything changes just because we're investing against a new thing. I think it's the same principles that exist from before. But there's definitely a lot of capital flowing in. There are going to be losers. Not everybody wins. That's not the way this world works. So I think it's increased due diligence. Due diligence materials now are hundreds of pages. I think gone are the days where people would just allocate capital. Allocation groups are much smarter and have gotten much bigger. And so I just think everything's gotten bigger, but the basic tenets haven't changed in terms of how you invest.
That's another really interesting point to bring up, which is the concept of scale. And scale being an advantage in certain strategies within private markets. Do you feel that there are areas of private markets, infrastructure as one example, maybe private credit as another as well, where scale actually does matter and presents an advantage as opposed to the other way around?
Scale is the concept that changes over time. We are always looking at where you can find the best deals. If you look at analysis, it's not always the largest deals that are the best deals. This is something we talk about a lot. What's the right size vehicle to pursue a strategy? If you meet with an investor and you've been running a strategy for a long time and suddenly you're now saying we're going to double or triple the size of that, I think that's a sort of a warning sign as well, because teams are used to looking for deals, used to looking for doing things in a particular way. We're suddenly doing things much bigger. So look, I think it depends on the strategy. I think there's deals you can get at every size that are good, that are able to generate alpha. So I think it's at every size you can find good deals. It's a matter about having high conviction about a strategy.
So we talk about generating alpha. I always ask the final question to guests on the podcast of what is your favorite or most interesting alternative investment? But given how we've talked about how much things have changed and are changing going forward, I'd love to hear the answer to that question with a twist, which is, what is your favorite or most interesting alternative investment going forward?
Well, so that's a tricky question. So in terms of favorite, I actually am very interested in early stage investing, particularly around the transition. I'm a very big optimist in terms of believing that we can get to net zero and that technology is going to be a huge part of that. I'm a big reader of Bill Gates and everything that he publishes, and believe that we will get there in terms of having enough smart people looking at how to solve this problem, and that humans have a lot of ingenuity. Although I don't personally invest, I read a lot about new technologies. So I would say very early stage decarbonization type technologies where they can have broader applications to save the world is where I find just personally a lot of interest. Because I've got kids, I want them to have kids. I want us to get to a great place. And it's way off my normal, we don't do this at Manulife. I just find it very interesting.
The interesting thing about that, though, too, and I had Bill Orem, the CIO of Capricorn, a $10 billion family office that focuses a lot on energy transition. They've invested across the life cycle in startups, but also then to do that well in particularly the space of decarbonization. Those things are actually linked together. Even if you don't do it at Manulife, in order to create the value chain of investments working, you need to be able to think about this holistically. The early stage equity investing will tie in with project finance investments. I think it's interesting, even though you may not do that at Manulife, it's interesting that you say that is an interesting investment category, because I imagine to some extent that's informed by some of the other things you see and how those things may ultimately be tied together to build a market.
I think you're right. The investment appetite and the investment capability around that is just very different to running a large platform, debt all the way through to equity that's less risky, I would say, but it does inform over 10, 20 years where the market's moving. And I think it's fascinating.
That's a fascinating way to wrap up, because it shows the breadth and depth of a space. It ties in with your career arc, which there has been so much that's happened both in your career as well as in private markets. And now you're embarking on building a massive platform on a business that is already large size and scale, but very excited to see what happens over the next 10 to 20 years. We'll have to be patient, as you say, but excited to see what happens and maybe get 401ks invested more in alts too.
Well, thank you. It's been great. Been great to chat, and thanks for having me.
Thanks so much for coming on the show, Ann. Really appreciate it. Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going mainstream.
The views and opinions expressed in this podcast are those of the speakers, are subject to change as market and other conditions warrant, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that the investment strategy discussed will be successful or achieve any particular level of results. Any economic or market performance information is historical and is not indicative of future results, and no forecasts are guaranteed. Investing involves risks, including the potential loss of principal. Financial markets are volatile and can fluctuate significantly in response to company, industry, political, regulatory, market, or economic developments. The information provided does not take into account the suitability, investment objectives, financial situation, or particular needs of any specific person. All overviews and commentary are intended to be general in nature and for current interest. While helpful, these overviews are no substitute for professional tax, investment, or legal advice. Clients and prospects should seek professional advice for their particular situation. Neither Manulife Investment Management nor any of its affiliates or representatives, collectively Manulife Investment Management, is providing tax, investment, or legal advice. Manulife Investment Management paper titled U.S. Farmland Investment Returns Continued Gains in 2022 from 5/19/2023, NCR EIF, collects U.S. farmland property-level performance realized by institutional investments and reports the aggregated results within its Farmland Property Index, FPI. Manulife Investment Management is a participating member in the FPI. The index requires participating members to report all eligible properties. Usage of this data is not an offer to buy or sell properties. Manulife, Manulife Investment Management, Stylized M Design, and Manulife Investment Management, Stylized M Design, are trademarks of the manufacturer's life insurance company and are used by it and by its affiliates under license. Manulife IM's largest natural capital manager in the world ranking is from IPE Research as of February 2024, based on total natural capital assets under management, AUM, which includes forestry timberland and agriculture farmland AUM.